Hi everybody, and welcome back to video number 2 on chapter 5. In this video we're going to examine and evaluate sales allowances. And sales allowances. What are those? Well, many companies offer a variety of different allowances. Sales discounts for volume purchases, for example. Even the right to return a product that may not meet their expectations, or some other kind of retailer promotions, markdowns, sales, those kinds of things. These reduce the amount of cash the company receives. And under generally accepted accounting principles, companies must report the amount of cash expected to be received, and as of course you know by now, that's going to be net sales. We talk about gross sales, and this is one of the items that we subtract from gross sales to get to net sales. There are some other allowances as well. All right, let's do an example here. Assume that Levi Strauss sells jeans to a customer for $130, and the jeans cost $80. But Levi Strauss is going to expect that returns of 3% of the sales dollars. So how does that look? Well, here we're going to make our allowance for sales returns to be $3.90 on $130. So 3% of $130, $3.90. We're going to debit the allowance for sales returns and credit accounts receivable. Okay, and when that accounts receivable, we eventually will convert that into cash. That's going to have an effect on the cost of goods sold. We're going to make an inventory adjustment for that estimated return. That's going to help our cost of goods sold, and away we go. And if it helps cost of goods sold, then during our closing entries, it's going to help our retained earnings. So here's what it's going to look like. We've got the sales at $126.10. That has the $130 less the $3.90 of sales allowance. The cost of goods sold is going to go down as well. That's a little bit of a help. And our gross profit is $48.50. So the companies provide a reconciliation of their sales allowance, and we also have the sales returns, but we also sales discounts and incentives. So in this case, we have some sales returns and some sales discounts also during the year, as this schedule reflects. All right, let's analyze these sales allowances. 3 metrics that we use for these sales allowances are the additions charged to gross sales. This is going to measure the income statement amount and reveals the effects of the pricing pressure on net sales. We expect the percentage of sales allowances to gross sales to increase, thus reducing net sales as pricing pressure increases. Then 2, we measure the balance sheet amount. This is going to be the effect on our inventory. And then we're going to assess the adequacy of our allowance amount. Now, in this case, we're going to establish an allowance for sales allowances. Okay, and how do we do that? Well, here's what we do. Here's our net sales here, and from that we subtract our sales returns and our sales discounts. Total $603,594, and that's the additions charged to gross sales. So that's going to be this $603,000 divided by our gross sales here of 6,179,000 and some change. Okay, and then we have some sales returns and allowances here, and sales discounts here, total 174,000. Those are the additions charged during the year, or 2.8%. So you see from this, we can take a look at the total estimated charge during the year, and then the actual taken during the year, and the adequacy. So we didn't quite provide enough in our allowance for that situation. All right, let's look at deferred or unearned revenue. This is a situation where we get paid in advance. And in some industries, it's very common to receive cash before recording revenues. Airline industry, for example, or the hotel industry. This creates a liability. We haven't earned that revenue yet until we actually deliver a good or perform the service. So with an airline, for example, we got to deposit those passengers at their location before we've earned that revenue. Or for a hotel, we have to have our people stay at the hotel and earn the revenue that way. So when the goods are provided or the service is rendered, the unearned revenue liability. Liability now, that's not on the income statement. It is reduced when the revenue is recognized. So the debit is going to be to the liability, unearned revenue, and the credit will be to earned revenue. Okay, so Lowe's. Lowe's tells us here how they do that. And what do they show? They show the service revenue and how they recognize that revenue associated with the services as they are rendered. The store value card, we're going to wait until those gift cards are actually redeemed here. And for extended protection plans, the company will recognize revenue from those extended protection plans on a straight line basis over the respective contract term. Okay, interesting. If the deferred revenue liabilities decrease, we can infer that the company's actual reported revenue was collected from customers in a prior accounting period, and there have been fewer new prepayments for which revenues will be recognized in the future. Not necessarily good in that case. It could predict a future decline in revenues and, of course, the resulting profits. This is not the case for Lowe's. As shown here, their deferred revenue has been increasing from here to here to here. All right, I think you see that schedule. Now, and here we're going to take a look at how foreign currency exchange rates affect revenue. And I remember this quite well. I had a yen-based loan, which was my idea, for $50 million. At the time, I could borrow locally in dollars at 6%. But at that time, Japan was only charging 0.5%. So we were a Japanese company, and after a lot of arm twisting, I got them to do that. Save tons of money, $3 million a year, something like that. It was one of my best ideas ever. And but it did create some problems, which I'll show you here in a second. The company's foreign subsidiaries maintain their accounting records in their local currency, foreign currency. other than U.S. dollars. But before those subsidiary financial statements are consolidated, they need to be translated into U.S. dollars. And now, if the U.S. dollars buys a smaller portion of those currencies, then our dollar has weakened. But if it buys more, then it's strengthening. When the income statement of a foreign subsidiary then is translated into U.S. dollars, the income statement can grow. But we report revenues and expenses are larger than before the U.S. dollar weakened. So the balance sheet also grows when a higher U.S. dollar value of assets, liabilities, and equities exist. So let's take a look at that for Pfizer. Significant portions, they're saying, of their costs and revenues were exposed to foreign exchange rates. 53% of the total revenues were derived from international. So you're going to have some exchange rate gains and losses in that situation. So if the U.S. dollar were to strengthen against other currencies, then revenues would decrease and a negative impact on earnings would exist. Therefore, significant changes in foreign exchange can impact those results. Very important to understand that. So here, revenues increased in 2018 due to those foreign currency changes. Now we can assume that the U.S. dollar weakened because those foreign companies' currencies can buy more U.S. dollars because they've strengthened against the dollar. U.S. dollars weaken, foreign currencies strengthen in this situation. So, 3 examples of how gains and losses can affect cash flow. The U.S. company transacts business in foreign currencies. Happens all the time. Car industry, for example. We may sell Jeeps in France, for example. For example, a U.S. company might write a sales contract in euros, which would be the case if we were selling Jeeps in France. If the U.S. dollar weakens between the date of sale and the collection of that euro-denominated receivable, the U.S. company is going to get a gain on that transaction. Conversely, if the U.S. dollar weakens, if they purchase goods and the U.S. dollar weakens, the foreign exchange denominated in accounts payable would grow, and the U.S. would require to settle that obligation at a transaction loss. I was negotiating some machines. They were about $5 million. There were 5 of them at about $1 million each. And I kept getting these wild swings in pricing from the Swiss-based company that was making those machines. And when I asked as to why that was swinging all over the place, they said, well, we're pricing it in U.S. dollars, and the Swiss to dollar exchange rate changed. Well, I finally said, okay, I will take the exchange rate risk because I knew more about it than they did and ended up making good money on that. So when we come back, we'll take a look at foreign currency and cash flows. And until then, bye for now.